How to bet on inflation the easy way. Inflation is real and has already started in the US and elsewhere. It doesn't have to be all bad for you if you know how to position yourself to take advantage. By the time you're watching this video, you'll know of a couple of ways that folks in the know will use to keep their money from being destroyed by inflationary pressures, and even ways you can get rich off of inflation. So be sure to lovingly, tenderly, gently smash that like button for the YouTube algorithm, and we'll get started. You're watching Finance Squared. I'm your host, Derek West, and talking all things personal finance is something that we love to do here on this channel. And that includes hedging your wealth against everyone's favorite economic phenomenon, inflation. For more real discussions on topics like this, be sure to subscribe to the channel with post notifications turned on. And with that little bit out of the way, inflation is a subject that a lot of people fear and few understand, which is true of many phenomena that people fear. With little understanding though, you can position yourself to avoid the worst effects of inflation. So what is inflation? I think Warren Buffett once said that only 2 people in the world really understand inflation, and he's probably right. It's a hard thing to predict when and where it can happen, but a lot of people know it when it is happening. Inflation occurs when more money is chasing the same amount of goods and services. In your mind, think of the two as separate entities, money and products. If a static amount of money is circulating, purchasing a static amount of products, then there will be no inflation. The thing is, in the real world, neither of those things stay static. People are always looking to produce more products, either as a way to make more money or just to experiment and try new things. And it takes money to do that, because in the real world, nothing is free, including the raw materials and labor that it takes to create products. And depending on how much money there is circulating in the economy, it either becomes easier or harder to purchase those raw materials to get those products made. In an inflationary environment, the money it takes to purchase those raw materials keeps going up and up and up, and that price is passed on to consumers. Now, what drives inflation? Well, it's pretty simple, really. It's the money supply outpacing the goods and services that the money supports. This is driven largely by the Federal Reserve in combination with the federal government. You see, the Federal Reserve is the only entity with the ability to print money, specifically US dollars. When the United States government needs money for activities, whether it's for the military, for welfare spending, or for funds to keep the economy afloat during pandemic lockdowns, if the money isn't available on deposit at the time, the government simply borrows it from the Federal Reserve, who in turn creates those dollars to loan to the US government at interest. A little factoid, the Federal Reserve actually issues digital currency. There's very little actual printing going on. And that said though, theoretically, that money must be paid back at some point in the future. The term of the loans are technical details that aren't necessarily germane to this discussion, mostly because I don't know what they are. And frankly, if the explanation gets any longer, I'll have even fewer viewers than I already have, so just take it from me. The feds borrow the cash from the Federal Reserve, which they must pay back in interest at some point in the future. How do they get the cash? The way any government gets the cash, by taxing the citizens, or by issuing bonds, which again are loans to the entities, people, companies, countries that purchase them. Keep that second option in mind, issuing bonds that is. We'll get back to that in a second. Whether you agree with how it happens or not, that system has been in place and worked relatively well and been relatively stable since the founding of the Federal Reserve System in 1913. A couple of noteworthy blips, including the Great Depression of 1929 and the stagflation era of the 1970s, when gas was super expensive and inflation was going gangbusters. The Great Depression was a deflationary death spiral, or at least that's what economists will tell you, and the 70s was an inflationary nightmare. A lot of people agree that we're just in the beginning of another inflationary period, but like I mentioned in the beginning, you don't have to sit back and watch your money become more and more worthless. There are a couple of easy ways to hedge against inflation, and there are also hard ways to do it as well. And the hard ways can make you rich if you do them right. Well, let's talk about the easy ways that people hedge against inflation. The key for all of them is to remember to yourself, when money is cheap, stuff is expensive. What type of stuff? All types of stuff. For example, commodities. As inflation ramps up, all kinds of commodities will see their value rise. Some will see their value fall as their overall importance to an economy falls, but most will see their value skyrocket. Let's talk through a sample of a few of them and how you can add one or more of them to your portfolio. Gold, silver, or copper. Typically, gold, silver, and copper can be added to your portfolio through commodity trading or through ETFs or index funds that hold these things. In addition to that, you can buy actual physical metal, such as physical coins for gold and silver, or actual copper piping for copper. Now, the option of buying those things physically has their own pluses and minuses. The minuses would be having to store the actual materials and keep them maintained, in pristine condition. In the real world, gold, silver, and copper can rust. That's why a lot of people choose to buy ETFs or index funds that hold these materials for them, or buy stocks in companies that mine these materials or use them in their own operation. But next up, we have lumber. Same thing with gold, silver, and copper. You either buy lumber and hold it in your backyard or in your garage somewhere, or you could buy it in an ETF or index fund. But another way that you like to buy and invest in lumber is to purchase real estate. Because you see, lumber is a big piece of real estate, as lumber is mostly used in housing and other construction efforts. Which takes us to the next commodity that a lot of people love to invest in, real estate. Real estate is exactly what it sounds like, purchasing houses or homes for people to buy or rent out. You can do that yourself, or you could purchase a REIT, that is a real estate investment trust. That'll just let you invest and let other people do the legwork of actually going out, purchasing the home and building it up and getting tenants, maintaining the property, etc. But then there are companies. Companies are a little bit more theoretical than the aforementioned commodities that I just talked about, but nevertheless, they are things that get more expensive as inflation grows. How would you invest in companies to ensure that your wealth grows? After all, investing in companies is fraught with all sorts of danger. Companies go bankrupt all the time, and the bigger they are, the harder they fall. So it's no guarantee that just investing in one company will ensure your wealth grows during periods of inflation. So invest in all of them. You can do that with index funds and ETFs. Index funds are baskets of stocks that track an index just like their name suggests. Some of the more popular indexes that they track are the larger indexes like the S&P 500, the Russell 2000, and the Dow Jones Industrial Average. But you can get index funds that are targeted to industries that you expect to grow in the near future, including tech-focused index funds, commodity-focused index funds. Just talked about them a little bit earlier in the commodities section, and even index funds that literally gather commodities. ETFs are similar to index funds, but they are an evolution of the concept of an index fund. An ETF is a basket of stocks or assets that you can purchase, but it can be traded intraday, just like a stock or a bond, and they typically have lower fees associated to them, as well as lower barriers of entry, like minimum investment amounts. Lots of index funds are starting to go in that direction as well, and I'll say this: it's a good time to be an investor with all of the low-cost investment options that are available to all of us. But that's not the only option for investing to hedge against inflation. And this might be a little bit impractical for people that live in a certain country if the currency that you are buying is not accepted a lot where you are at. But if the currency you are using is inflating like crazy, other currencies will start to become real popular where you live real soon. Forex markets, foreign exchange markets that is, are the places to go when you want to start purchasing large or even small quantities of other currencies to trade with. But probably the best type of currency to invest in and to purchase to help you hedge against inflation is cryptocurrency. I'm sure we're all aware of the volatility that has surrounded many cryptocurrencies the last few months or so. Well, when inflation goes nuts, the value of these crypto tokens will go nuts as well. Pick your favorite crypto: Bitcoin, Ethereum, Polkadot, Cardano, Chainlink, you name it. It will likely grow in value as the value of the US dollar and other fiat currencies fall. Cryptocurrencies have the added benefit of being a new technology that will likely change the way that we do business with each other in the very near future. Also, most of them are independent of central banks and corporations that have sway over the dollar and fiat currency, meaning that they are more than likely not at risk of mega inflationary pressures themselves. But a quick word of caution about this strategy and all other strategies around hedging your bets against inflation. Each of these tactics is really only a way to not be left holding a worthless bag of US dollars. Remember, if any of these asset classes increases in value, only because the US dollar is decreasing in value, you are only really treading water. You aren't getting any wealthier relatively. You only get wealthier if the asset class you are holding not only matches the rate of inflation, but beats it by a significant margin. And there are ways to do that. You just have to find them. Your first step is to make sure you're subscribed to this channel with post notifications turned on, because in our next video, we're going to talk about a finance tycoon who just so happened to accurately predict the problems with credit default swaps that kicked off the 2008 financial crisis, and his interesting plan to not only avoid inflation, but to profit from it. So be sure to like this video if you liked this video, and drop us a comment down below with your thoughts on beating inflation the easy way. Are you invested in any of the inflation hedging instruments that I talked about? Talk to us in the comments. We're all dying to know. And remember, a goal without a plan is a wish. A goal with a plan and no action is a wish list. Take action on hedging against inflation today by considering investments in inflation-busting asset classes. And we'll catch you next time. Peace.